So, you decided to start investing in real estate, and you're thinking to yourself, oh man, taxes are going to be a nightmare. How am I going to save money on taxes? Well, I'm sure that, you're probably familiar with a 1031 like kind exchange, right? Where an investor can defer a tax liability from the sale of a property by acquiring a similar investment property, capital gains, depreciation, state and local income tax, and the 3.8% net investment income tax. Essentially, this allows you to sell one property and purchase another without paying any taxes, provided you follow some basic rules. For example, one requirement is that you identify the replacement property within 45 days of the sale and conclude the purchase of the replacement property within 180 days of the sale. Some investors even take the swap until you drop approach, where they continue to sell properties and acquire new ones without ever paying taxes on the sales. In addition to the tax deferment benefits, a 1031 exchange gives your heirs a step up in basis to current market value when you pass away. For example, let's say you bought a property for $500,000 and it depreciated, over 20 years. So the property is now valued at 2 million, and you and your spouse, they pass away. Now, your heirs would automatically receive a step up in basis to 2 million. So they can sell the day after you pass away and pay no taxes. There's one problem with the 1031 exchange for a lot of investors, though, and that's the current property investment environment. While the present market might allow an investor to sell, their property at a record high, they're also going to be in the position of having to pay a steep price for a replacement property. And then with the 45-day clock ticking in the background, a lot of investors may not have adequate time to identify a suitable replacement property. This kind of fevered market can lead investors to make less than sound choices. Tax savings don't make a bad investment decision good. It only makes a good investment decision better. But luckily, the good news is that there's alternatives to the traditional 1031 exchange. The first one we want to talk about is the Delaware Statutory Trust. Instead of reinvesting the proceeds of your property sale into another investment property, you could exchange those proceeds into a Delaware Statutory Trust, a DST. Now, a DST is a legally recognized trust that has been established to conduct business. Most DSTs hold institutional grade properties. In this sense, they're similar to real estate investment trusts, right? REITs, but they offer investors the option to invest in them as part of a 1031 exchange, which is typically not possible with a REIT. A DST has several important advantages. First, it eases issues stemming from the time constraints of the 1031 exchange, as it's simpler and quicker for investors to identify an appropriate and established DST than a replacement investment property, particularly these days. Secondly, it enables you to remain invested in current real estate as an asset class without the stress and time commitment of being a landlord. It can also be a particularly valuable solution for investors who mortgage exceeds their tax basis in a property. DST is going to generally require a 5 to 10 year time commitment. They typically distribute income and potentially offer the opportunity for capital gain or loss. However, to qualify for a DST, you've got to be an accredited investor. The next thing to talk about is going to be opportunity zone funds, right? This is something, you should also consider. An advantage of this strategy is that it allows you to invest just your capital gains and depreciation recapture. This enables you to sell the property, withdraw your tax free basis, and defer the additional taxable funds. Some, not all, states are supporting these tax breaks by ensuring the state and local income tax rules are aligned with the federal tax regulations. Now, by investing in an opportunity zone fund, you defer your taxes on the eligible capital gains realized within the last 180 days until tax year 2026 or April 15th, 2027 filing deadline. Now, If you invest in an opportunity zone fund before the end of last year, you will also receive a 10% step up in cost basis. Many opportunity zone funds also structure a cash out, refinance of about 30 to 45% in time to pay your deferred tax bill. As with a DST, opportunity zone funds can provide annual income, generally from year 4 or 5 through about year 10. Now, further, if the property is held for 10 years and 1 day, it receives a step up in basis for both appreciation and depreciation. This means that the property could be sold without triggering any capital gains tax liability. However, similar to a DST, it's important to conduct due diligence on both the underlying investment and the manager of the fund. Opportunity zone funds typically represent a 10-year investment structure, and you must be an accredited investor. The next thing to talk about is going to be deferred sales trusts. Now, one lesser known but potentially beneficial option, right? But with a deferred sales trust, you can sell your highly appreciated assets, right, including, investment properties, primary residences, vacation and second homes, and defer the capital gains taxes and depreciation recapture taxes almost indefinitely. In a deferred sales trust, you are not the owner of the trust. You are a promissory note holder against the asset of the trust, and the trust makes payments to you. To effect this, you would sell your investment property to the trust, and the trust, in turn, would sell the property to the end buyer. The proceeds of the sale are paid to the trust at the time of closing on this, simultaneous transaction. One significant advantage of this approach is that an investor doesn't have to contend with the 45-day time constraint inherent to the 1031 exchanges, but there's other things to, consider to think about. What if you could use the funds from a sale in 2021 to buy real estate later without having a tax liability? Imagine if you sold a property in 2007 at the peak of the last cycle, and you were able to park the money on the sidelines and then use it to acquire properties in 2010. There are many different ways to structure a deferred sales trust, and it can even potentially be used in combination with a 1031 exchange or paired with an opportunity zone fund. The deferred sales trust can be structured to pay just interest payments on your promissory note or principal and interest payments. If you choose principal and interest payments, then you would be responsible for some of your capital gains taxes and depreciation recapture taxes, right? But most investors that avail themselves to a deferred sales trust structure choose interest only payments that are taxed as ordinary. This lessens your cash flow from the trust, but it also, kind of alleviates your tax burden by deferring taxes owed on capital gains and depreciation recapture. Now, deferred sales trusts are structured to run for about 10 years, but they can be easily extended for multiple additional 10-year cycles. Now, it's worth noting that deferred sales trusts are a bit more complex than some other vehicles or strategies that investors might be considering, and they there are carrying costs and trust establishment fees to contend with as well. But if you have capital gains that exceed, $500,000, this could be a viable option to think about. Whatever tactics you elect to use, the most important thing, is going to be to weigh these strategies against your short-term and long-term objectives for the property, as well as your short-term and long-term objectives of your overall portfolio. Tax strategies should be merely one facet of a holistic approach that is going to foster, enduring value for your assets. So think about what your goals are and then try to move forward from that and make a decision off that. And of course, always, always, always talk to a professional, right? But I hope you guys got some good information on this video. If you liked it, hit that thumbs up button. If you're not subscribed to the channel, I'd really appreciate it. But until I see you guys in the next video, y'all be safe.